Problem? With free capital markets, as long as the firm's value or assets exceed its liabilities, it can repay the loan. If,
Did you get this?
hmm?
Yes, yes, I have one.
Are you hiding the notes? Firm has access to capital markets, can issue securities at a fair price. Okay. Fails, it's only worth 80. What happens? Who suffers this loss? Debt holders. 20 minutes. Okay. Without equity, equity holders will lose $20 million. With the debt holders will sue it. So not really, you can kind of see why a debt holder doesn't want the company to issue what? More debt, right? Doesn't make any sense. As an equity holder, I can care less what they do. Both debt and equity holders are worse off. Without leverage, product fails. Holders lose 70 million. With leverage, equity holders lose 50 and debt holders lose 20, but the total loss is the same, it's just distributed differently. And for debt holders, even though that loss is small, it's substantial because remember, equity holder has all the potential upside, right? Debt holder, I'm getting a coupon. And then hopefully get paid back in 1 year, right? I know I make that sound exciting, don't I? Buying a bond. That's why debt holders are very, debt investors, people that are very risk averse. Here's a little chart showing that. Success and failure. New product fails, armed investors are equally unhappy. Whether a firm is levered declares bankruptcy, whether it's unlevered and share price declines. Declines, economic distress. Bankruptcy and capital structure. Oh, the Millennium Note. Number 1, total value to all investors does not depend on the firm's capital structure. There's no disadvantage to debt financing. What do we think about that? There's no disadvantage to debt financing. Yeah. Why?
Because
Say why.
The risk that you have to pay that $100 million back in a year.
But debt gets more expensive the more I borrow. That's what's not taken into consideration here. We'll be able to raise the same amount initially from investors with either choice of capital structure. We know for ourselves, personally, once you go into more debt, what happens to lending? Try to get a loan. Same thing for companies, right? So mean. Equity unlevered. What am I discounting it by? The risk-free rate. We said 150. There's a 0.5% chance of that occurring. There's a 50% chance of that occurring. 50% chance I fail. What's equity unlevered? Take those two, multiply by 1/2, add them together, divide it by 1 plus the risk-free rate, I get what? 109 is about 5.2. Equity levered. Notice the 0. Why? Why is 0 in the equity levered?
Because we have a loss.
I take the 50 million, right?
Yeah,
Who takes the $20 million loss?
the debt holder.
So So my equity, and then discount those at the 1 plus risk-free rates, 23.81, 85.7. How much did the equity holder really lose then? I had 70 million in equity, right? Less than 50, right? In present value terms. How much did the debt holder lose? Had 100, now I had 85, right? 15 in present value terms. And if you add those two together, that should equal to 109, it's 552. Mobilini Miller. Supposedly that verifies the proposition. Okay. The only thing that nullifies the proposition is the more debt we issue, the more expensive it gets. The bankruptcy code, 7 and 11. All right. 7 is liquidation. There's no restructuring. Trustee is appointed to see liquidation. Who is the trustee appointed by? The bankruptcy judge. There is bankruptcy code, yes, the corporation. Okay. Trustee is supposed to look out for the debt holders of the corporation. We assume that the equity holders aren't going to get anything in the bankruptcy. And 99.9% of the time, they get 0 on this. Okay? Look out for the debt holder's best interest. Could be an auction. Could be people making bids for it. You can even sell the name of your company, believe it or not. Remember a company called Sharper Image? Somebody bought that name. Not sure why, but they bought that name. So even the name of the company will have value. There was 8 o'clock coffee, I think now it's back at the grocery store. Somebody bought that 8 o'clock coffee name. You wait long enough, people forget maybe there was bankruptcy. Might somebody buy Radio Shack's name? Possible. If the trustee thinks it has value and it'll pay the debt holders, guess what? Sell the name. Chapter 11 is reorg. Most common. Chapter 7 is very rarely executed first. Usually they try to do it Chapter 11. We're going to restructure the firm. Why? Because we think there's value there. If we can restructure it, all the debt holders kind of have to agree. Then they submit their plan to the bankruptcy judge. If the bankruptcy judge feels that it's good enough for all debt holders, it's appropriate, he approves it, they can do it. What more than likely happens, the debt holders take some cash, and then they receive equity in the new firm. So now they have upside in that firm. Maybe they take 30 cents on the dollar in cash, and then the 70 cents is some kind of equity instrument.
But the overall value remains the same.
Hmm?
The overall value remains the same.
So, now we all have to sign this, right? That's a problem, isn't it? Just getting 9 people to agree to something in a room, right? With no money involved is a problem, right? Think about when there's money involved. Because who's going to do better? Well, the senior debt holders are going to do better, right, than the junior debt holders, because I got first. So if you try to take away more money from me as a senior debt holder, I'm going to go, no, I want cash. I'll take some equity, but I'm going to want more cash than you get as a junior holder. So if somebody is really interested in doing this and reorganizing the firm, it is best to buy out the other bondholders and control a higher percentage of the bonds than everybody else. Therefore, you can kind of get your reorganization plan done. Eddie Lampert with Kmart, that was what he did. He bought out the bonds of Kmart and tried to make a go of it. And he's not much of a retailer. Creditors may receive cash payments or new debt. They probably will receive both. And they probably don't want new debt. as much. Why? They want the company to be as debt-free as possible. Okay? What's better when it's debt-free, right? Creditors must approve. Then, if it doesn't work out, Chapter 7, I mentioned this before, I think, Borders. Borders tried to do Chapter 11. Nobody wanted Borders. Nobody wanted any part of Borders, so then Borders Bookstore went Chapter 7 liquidation. Time-consuming and costly. Guess who's costly?
Lawyers.
Bankruptcy attorneys. Guess who loves to see bankruptcy? The attorneys. Lehman Brothers, I just read last week, $2 billion worth of legal fees in bankruptcy. Those are direct costs. It's obvious, right? You're paying them. When the bankruptcy attorney comes in his own private jet, he's doing pretty good for himself, right? So direct cost, workout. Which firm directly negotiates with its creditors. I'm in distress, but I'm not in bankruptcy yet. I want to negotiate with you before anything happens. If we have a long-term relationship, I might be able to work a deal with you. Maybe I can't pay you this coupon now, but I promise in a year from now, I'll pay you twice that the 2 coupon payments, the back payment and the one that's expected. What does that person, the creditor, have to do? Sign off on that. Make sure it's okay. Pre-pack bankruptcy, General Motors and Chrysler. Before they filed Chapter 11, they had that plan already done. Well, how did that work out with the debt holders? How come they agreed so fast?
They wanted something rather than nothing.
Who told them to take this? The
Government.
government said basically this is what you're getting as a debt holder. Is that theoretically illegal? Yeah. As an investment professional, do you really want to make the government and the IRS mad at you? No. In fact, they were talking about some investment firms trying to sue the government on behalf. Wise idea? Probably not, no. If you want to continue living here and working here. The pre-pack, so pre-pack's ready to go before Chapter 11's filed. So, General Motors and Chrysler, here's our Chapter 11 filing. Judge, boom, here's our pre-pack. That's why it was done within, 30 days. Okay? They're getting more and more common because then you spend less on attorney fees. Bankruptcies can go a year, 2 years, 3 years.
So why not all the corporation or the businesses go through prepackaged products?
You can't get the creditors to agree.
Oh, there are some requirements to do it?
All the creditors have to agree.
Oh, okay.
Because they're going to be the new owners in the company. They're going to want a stake in that company. And if a certain percentage don't agree, guess what? It's not going to happen.
So why they're gonna agree? What's what they're gonna receive in exchange?
Some cash and equity in the new firm. But there's going to be a fight over the percentage of cash and the percentage of equity in the new firm. Because remember, there's senior holders, there's other debt holders. Now, if I own a mortgage, if my bond is secured by a building, I can just take that building, I'm done, I'm good. I don't need to participate that long. So that building would be separate from that bankruptcy, because it's mine. I take the building, I don't want to be involved in it, I just want to take the building and get out of there, okay? So pre-pack, the basic thing of pre-pack is trying to get everybody to get together. With General Motors and Chrysler, government said, you will take this. Okay, yeah. Indirect. Guess what happens? Hey, Mayor Borders is going out of business. Rumor,
Yeah.
right? In fact, people weren't buying cars as much during the bankruptcy process. Why? What about my warranty? Yeah, what's gonna happen, right? What about my warranty if I buy a car now? I'm not gonna buy a car now, are you crazy?
Did Saab go through a big headache? Saab, that car manufacturer, then
GM owned them, they sold them, yeah.
Okay, well, they bought them?
They sold, GM sold them, yeah, they own them. I can't remember who owns Saab now, but GM had to get rid of them in bankruptcy. Remember GM, and remember Saturn? They had to get rid of that in bankruptcy too, nobody wanted that. They were trying to sell it, nobody wanted it.
One of my friends bought a Saab, and then a couple months later, they were.
I don't know why GM owns Saab in the first place, that was weird things happening. Ford and Jaguar. Shoot down to Ford, do you want them to make Jack? No. They just combined. Loss of customers. Don't want to do business with. Loss of suppliers. Hey, if Borders is going bankrupt, do I want to deliver books to them? No, then I got to come back and actually cut them off. Why bother?
So,
Loss of employees.
in case of Chapter 11, what happens to the suppliers? So the supplier has provided some stuff to the company.
Supplier has right to that. But his case isn't as strong as the bondholder. Because with the supplier, what do you have? You have an invoice, right?
Right.
With a bond, you got a legal contract. So if I'm a supplier, I could eventually get it back, but guess what? Let's just not deliver. Let's stay out of that mess totally. They don't even bother anymore. So with Borders, that's what happened with Borders. People have heard the suppliers heard rumors of bankruptcy. Why bother? Why deliver? Stay out of it totally. If I'm lucky I get it back in a month, why bother? Just not don't even deliver. See what happens. Employees. Hey, we're going bankrupt. Let's see. Let me update my resume on LinkedIn, right? Let me update my resume. Let me start shooting emails off. Am I working as much as I used to? No, I'm preparing my resume. I'm trying to get interviews, right? I work. Receivables? Also, there could be assets sold very cheaply. Indirect costs could be 10 to 20% of the firm. Also, what is upper management doing?
Searching for new jobs.
But they're also trying to prevent it, right? Are they focusing on their day-to-day work? They're all talking to bankers, trying to get financing, trying to this, trying to that, going on TV, saying everything's okay. And that's a lie, various times. So the impact of financial distress costs with a $100 million debt, Armin will be forced into bankruptcy if new product fails. Sales values of assets will be lost to bankruptcy. Assumed debt holder will receive only $60 million after accounting for financial. So they're going to lose an additional $20 million. To what? Tax attorneys. And then on the indirect side, distress costs, right? People not working anymore because we know this is going downhill and we're going to get off the boat right now. Why? I'll get my resume out there first because a bunch of people are going to get resumes out there. Be loyal to yourself. Who pays for financial distress costs? Who do you think pays for financial distress costs? The debt holders. Especially from the attorney side. Especially from the attorney side, right? Attorney's going to take up all that money. I make the attorney sound bad, right? Yet if you hire an attorney, you want a shark, right? You know, the guy who's going to go through that. Trade-off.
He's a scumbag, but he's your scumbag.
He's my scumbag. Yeah, he's dirty, but he's my guy. Exactly. If he wasn't hired. The firm picks its capital structure by trading off the benefits of the tax shield. The more debt we issue, the more interest deductible, right? So when we get down to EBIT, we go below EBIT, that interest line gets bigger. Therefore, I pay less taxes. Also, the more debt I issue, the more expensive it gets, thus my WACC gets bigger. Thus, I can't do as many projects as I've done before. The NPV is different now, right? Okay. The value of the levered, value of unlevered, present value of interest tax shield, minus present value of financial distress costs. Probability of financial distress, how likely it is that we're in some kind of financial distress. Okay. Magnitude of costs after a firm is in distress. The bigger the company, the more the costs are going to be after I'm in distress. Okay, more money. The appropriate discount rate for distress costs. Present value of distress costs will be higher for high beta firms, meaning high risk firms. Low levels of debt, risk of default remains low, obvious. The trade-off theory, firms should optimal debt. That's pretty obvious, right? What's your optimal debt? It depends upon what kind of company you have and what kind of industry you're in. If you're a capital-intensive industry, you probably have to issue more debt. If you're in a software industry where you don't need a lot of buildings, a lot of machinery, guess what? You're going to have less debt. Just heard today, Google might be getting into the insurance business. I don't know why. Google Insurance. You know the company that sells the stuff where you click on it and then they make money as an advertising firm? They want to do insurance. Okay. Greenleaf Industries considering adding leverage. Means they can add 35 million in debt. That's their maximum. Tax shield, 15% is their maximum. Higher debt increases. So this top line here is what? Percentage of debt. 10, 20, 25, 30, 35. Notice, my interest rate is doing what? Increasing as I go along. Financial distress costs should increase when my debt increases, right? So what's my optimal level of debt? Which two, when added together, create the best value? That'll be, at 20 it's what, 262? At 25 it's what? 213, right? I'm just taking the top, the 3 and subtracting 38, I'm taking the 375 and the 162. So I'm thinking that between 20 and 25 is where I want to be for my debt percentage. Okay? It's optimizing my tax shield and my distress cost. Oh my gosh, I almost know what I'm talking about. So 150 and 262. And 262 and 213. Where's optimal? I'd probably choose 20. And debt. Okay. Now, which is optimal for this one?
$30.
20 or 30? Who says 20? Who says 30? One side up, calculators out, Excel out. You can't add or subtract, it's too late at night. 8.32? That would put me where? 30%, 30 million? What do we think? Huh? We want to put ourselves where the biggest net gain is. Agency costs. There's a conflict of interest between the stakeholders of a company. I'm an equity, I'm a stock owner, I want more leverage. As a debt holder, I want less leverage. There's your conflict, okay? Management usually looks at the equity, wants to make decisions that increase our equity. Benefit the shareholders, sometimes you harm the creditors. By issuing more debt, new project, more debt, harms the debt holders, but could also make the equity holders more money. Because the company owners don't have stock option debt, they have stock options. They don't own debt in the company, do they? So what are they going to do then? Well, on the equity side, right? Take interest rates off. Baxter's loan of $1 million. The market value will only be $900,000, and Baxter will default. Uh-oh. Baxter considering a new strategy, no upfront investment, and 50% chance of success. New strategy succeeds, it'll be 1.3 million. New strategy fails, the value of the firm's assets will fall to 300,000. So this is slide what, 16, 7? Chapter 16. Chapter 28. There. All right. So we have 1.3 and 300,000, right? And what's the chance of it succeeding?
50%.
What's the chance of it therefore failing? What do? Take my expected values and add them together, right? So 0.50, 0.50 times 1.3, 650. And then will that equal? What's that? My expected value, right? 800,000. How does that look? If I take a $1 million loan, how does that 800,000 look? Hey, right? Some expected that Baxter should go ahead with the strategy. I'll bet you these people hold stock, right? They're assuming that it's going to work, right? How do the shareholders benefit? Equity holders would receive 300,000 above the 1 million, right? 1 million would go to the debt holders, 300,000 would go to the equity holders. Given a 50-50 chance, their 300,000 times 50% would be 150. That's their expected payoff. Equity holders, let's express it this way. Okay? Equity holders, you get 300,000 or what? Nothing, right? No. So their expected value would be 150. So this is expected this is called expected value loss of the 800,000 for the firm, and then for the 150. Well, guess what? If the equity holders get 150, what are the bondholders going to get?
$150,
Hmm?
the same?
Mm-mm. Hmm?
Don't they
What
get
was the
paid?
expected value of the total firm for the project?
Oh,
Was it going to be 1.3 or 300,000? That 800,000, right? If the expected value is 150 for the
650 then?
650. 650.
Do bondholders get paid first? Okay.
The bankruptcy, what do equity holders get?
What about that?
The expected value.
Debt holder, 650. Debt holder could be 650.
By simple subtraction, the debt holders are going to get 650. Right? Make sense? Using this one too. So once we figure out what the expected value is, oops, look, plus that, minus that. 650. And that's for the debt holders. Expected value. Let me see. Let me get emails. Where's that thing? Risk taking, equity holders from strategy, project fails, we said 650. Take the 50% if you want to work it out. 50% times $1 million. 50% times 300,000. That 300,000 is gone. The 1.3, that's gone. Notice how it's 1 million, right? What's the best the debt holder can do? 1 million. The equity holder gets anything above the 1 million in the best case scenario. Other case scenario, 300,000. 50% of that goes to debt holder, therefore 650. Okay? Make sense? Over-investment problem, firm saying shareholders can gain expense of debt. Incentives, never going to do projects. Baxter. No, we'll assume Baxter does not pursue the risky strategy, but consider investment opportunity of 100% will generate a risk return of 5%, risk-free return. 50%. Really? Risk-free return? Okay. Current investment rate is 5%. Of course, the investment's going to have positive NPV, right? I borrow at 5% to make 50%. Could Baxter raise $100,000 in new equity to make the investment? Okay. Without projects, we're going to stay at 900. With the new project, and now 150, give me a total value of 1050 of equity of 50 million. I either do 150 or I do 50. Equity holders contribute 100,000 to fund the project, and they get back 50. Make a 50% return, right? Which is great for equity holders. For debt holders, they'd be very upset. They only get 50% of their money back. The other 100,000 goes to the debt holders. Pay off the 900,000, or from 900,000 to 1 million. Underinvestment problem. Cashing out. Bond sell-off, stock sell-off. Everything within the company sells off when they're trying to cash out. I love that. Use value. Firm has leverage, two effects on the share price. Equity usually is happy with it, debt holders are not. Agency cost. Capitalization, leverage ownership, yes, yes. Debt maturity costs. So a covenant on the debt is a restriction put on the company. You cannot pay dividends while you have this hard debt outstanding. That works to the benefit of who? The company or the debt holder?
That's all.
Therefore, the company will do what? Require a higher interest rate on that bond. Covenants protect the debt holder. Management entrenchment, motivated managers, their paycheck. Concentration ownership. Reduction of wasteful investments. Any questions? So there was homework for this week, right? Some of you have already handed in homework.
So
So week 6 already?
What's that?
Mhm.
Yeah,
Mhm.
that's 2
So week
weeks.
6 stuff is not on the quiz. This week's stuff is not on the quiz.
So it's just chapter 20,
23 and 25.
that's it?
Yep.
Can you give the
Okay.
answers?
No.
Quiz is just 20 to 25, right?
Yeah.
Wow.
And what I sent you in the email, make sure you cover that stuff.
Okay.
Review.
Okay.
And we got homework. So the quiz we do by when?
Next Tuesday.
Next week.
You know up to here, right?
Hmm?
You know up to here, so you just write the answers and we'll post it.
I have this question, but can you please?
Well, you're running the class, so
No, it's like general question. It's of bankruptcy, like, do like the creditors of the bank, like, go after the personal property of,
if it's a corporation, no.
if S corporation?
No.
Just like for limited agency, LLC?
Correct.
Okay. Or maybe sole partnership.
Sole proprietorship, they come after you. Sole proprietorship, your name and the company are the same. House, car, whatever. There are certain states where that doesn't work. In Florida, you can go to Florida and a lot of automotive executives fearing lawsuits after they went bankrupt, all of a sudden they build houses in Florida. They can't take your home, so they can't take your personal property in Florida. Or on a bankruptcy or personal.